My name is Tom Long. I'm with Daily FX. Once again, I see a lot of familiar faces, so I won't get into too much detail about my background, other than I've been in Las Vegas for 2 whole days now. So instead of me introducing myself, I thought we'd do something different, that each of you would stand up and introduce yourself to the rest of us, starting with you, sir. Nah, I'm not serious. I just thought I'd change it up a little bit, you know. Today we're going to talk about high probability breakout trading, okay? And specifically what we're going to talk about is some of the most famous traders who have ever walked the face of the earth and how they actually traded the market. They were nice enough to share a lot of information with us. We're going to talk about W.D. Gann. We're going to talk about Richard Donchian, who some of you was in the last class who kind of exposed to a little bit of his work. And more importantly, we're going to talk about a story that everybody in here should celebrate, and that is the story of the original Turtles from Chicago. We're just a group of traders who were recruited by 2 successful traders, and the bet was, they made a bet. One guy said you could teach trading. The other guy said that traders were born, not made, and the good news is the first guy won. Okay? So they were called the Turtles, and they went on to make hundreds of millions of dollars in the market, and most of them knew nothing at all about trading. And within about 90 days, we're trading $1 million accounts for this guy. But we're going to talk about some of the approaches that they used. And that should all be good news for all of us. Okay? Trading can be taught. Okay? Traders are not made. Yes, sir, you're doubting me already. Trading Places. Well, you know what? It's funny because it was happening about the same time. So, there's an argument about which came first. Eddie Murphy learning how to trade, coming out of the Special Forces unit in Vietnam and, to trading, and or the Turtles, but we'll talk about them. And particularly, a lot of them have shared a lot of the style of trading that they used. And they all used a breakout type of trading, so we're going to talk about that. But of course, we have to take a step back, and we have to talk about, in what kind of market situation we're looking for to make it a high probability breakout trading, because that high probability is kind of a big word. We like high probability trading. And those of you who have been in my talks, we're going to start off with, my reminder. And I always make it the second slide to make sure I don't talk too much before I talk about that these investments in FX are speculative investments that should only be with risk capital. Okay? Money that has to be made in the markets somehow disappears. Okay? The markets know when you have to win, and they will do everything they can in their power. Sometimes I say she, but I don't like to do it in mixed company. But she will do everything in her power to make sure you lose. Okay? Believe me. And there are many people, I see some heads already agreeing with me in this room, know that that's true. Okay? It's not until we're detached from the outcome of a trade that we can have some sort of control over our own actions. Okay? But let's move on. A breakout is defined as a move up through resistance or down through support. Okay, sounds easy enough, except what the heck is support and resistance, okay? And there are numerous ways to identify support and resistance, and we're going to talk about some specific ways to do that today. By the way, I do like to make this casual, so if anybody has any questions, you can put your hand up at any time, because I know that there's about 15 other people wanting to ask the same question. And usually it's something that I've missed or haven't explained properly. So I really don't mind when people raise their hand and ask questions during the workshops. One way to identify support and resistance is just highs and lows. Okay, you can do, this is easy to do because we're doing it after the fact, obviously. But resistance is just the price level where the market stopped moving up and reversed to move back down. Support is nothing more where the market moved down, found some support, reversed and moved back up. Okay. We identify a downtrend as lower highs and lower lows, lower support and lower resistance. Okay, this is a downtrend. In downtrend, we want to look for selling opportunities. We want to trade with the trend of the market, especially breakouts in the direction of the trend. Now, on the flip side, we have an uptrend. This is the Aussie Swiss, a daily chart of the Australian dollar Swiss franc. Okay, we can see that the market's a series of higher highs and higher lows. Okay, Again, I'm doing this after the fact, but as a matter of fact, when this market moves back up close to this resistance, I already know this is support. I don't have to wait too much longer. Basically, I'm not identifying this as it's happening. I'm identifying it more up to this point where the market's already bounced off of support. But there are other ways or other tools that we can use to make it even easier for us to identify those levels. Now, the first step, of course, in identifying any trade, but particularly a breakout trade, is to identify the strong trending markets on the daily chart. Okay? This is one thing that I've been talking about for 2 days, and I really think is the key to successful trading is to identify the strong trending markets and jump on board in that same direction and hang on for as long as you can. That is trading. That is what trading is all about. Okay? As soon as you deviate from that kind of stuff, you're just making it more difficult on yourself. Can it be done? Are there people who can trade against the trend all the time and be successful? Sure, there are. But I'm guessing for every one of those, there are 10 traders who are successful trading in the direction of the trend. Okay? So it's just a matter of finding edges and exploiting those edges till they disappear, or trading with the momentum of the market, or trading like the successful traders before us have already traded. Okay? There's no reason to reinvent the wheel. There's nothing new in trading. You know, we may have thought we found something new, but there is nothing new. Okay? Everything, I'm sure, has been tried at one point or another down through time. And the breakout is obviously that I don't have the chart up, and I have it right here in front of me too. Okay, this is a chart of the pound Aussie. I just want to take a few minutes and go through the process I do in identifying the strong trending markets. As most of you know who have been in my classes, this is the 200-day simple moving average. This is one technical indicator that I have on all of my charts. Okay, it just gives me a quick reference point in the direction of the trend. Obviously, the moving average is moving down. The market is moving down. There's nice separation between the two. This is a daily chart with 1 year of trading, and that's where I start. Actually, I start with the euro dollar and work my way down through all the currency pairs. I'm just looking for the strong trending markets. Okay, if your market is in a range-bound situation, there really aren't going to be a whole lot of breakouts. Okay, eventually it will, but you could have 3 or 4 losing trades as the market just reverses its support, moves up the resistance, and just keeps doing that, just like watching a tennis match. Okay, we want to look for those strong trending markets because that's where the big breakouts are going to be. Okay, the market is trending for a reason. We want to take advantage of that. This is the dollar CAD. We have a similar situation. It's a nice downtrending market. Okay, it's below the 200-day moving average. This is not a bad pair to look for selling opportunities in. But I like to pick the strongest trending markets. Okay, and typically that's only going to be about 3 or 4, maybe 5 currency pairs at any one time, out of the 35 or 40 or whatever the number is. Actually, I only follow the pairs that have kind of the tight spreads, usually 5 pips or less. So I think last count I was following about 18 different currency pairs. Okay, but believe me, that's plenty. That is plenty of trading opportunities by following 18 currency pairs. And usually you only find maybe 3 or 4 or 5 in strong trending moves. Okay, and that's fine. That's all you need. I've never really seen a situation where there wasn't at least one currency pair in a strong trending move. That was a couple of years ago. The Aussie Kiwi all the others seemed to be changing trends, but the Aussie Kiwi just kept making new highs and new highs and new highs. So I was just trading the Aussie Kiwi. And then eventually they all started breaking out in strong trending moves, and then I went from 1 to about 7, and it's fun when there are that many strong trending markets, because then you can really start cherry picking what you think is the strongest trading opportunity. But this is really the first step on any kind of approach you should use in trading, is looking for the strongest trending moves. For those of you who have been in some of my workshops, this is really my favorite pair right now, and it has been for quite a few months. It's the Euro Aussie. It's a 13-year low right there. I mean, and it just happened at this time. Well, this is a little bit earlier, but this market is continuing to move down today. I know a lot of people were more than pleased to point out to me that I missed some great trades, unlike the Euro Aussie and the Euro CAD, because I got in town Friday night. Yeah, I like to play too, and but that means that I missed, the trades, because I've really been out of the loop since that point, so I missed it. But this is a strong downtrending market. Yes, ma'am. Basically, back a few months before this, the market made a new year low, and it moved down through the 200-day simple moving average. At that point in time, you can look at it in the chart, and it just seems obvious to you. Okay, but that's why I have this on here. It's just another way of identifying that situation. Okay, But I really like to see a low of the year and below the 200-day simple moving average for a downtrend, and the flip side, a new year high and above the 200-day simple moving average for an uptrend. Now that doesn't always happen. I don't know if I have the EuroCAD chart here. Let me take a quick look through. No, I don't. But the EuroCAD did not break down and made a new low until maybe January of this year, and it was below the 200-day simple moving average. But at that point in time, it made the low, and it's almost been in a parabolic move to the downside since that point, too. Okay, but basically that's why I use about 1 year of trading. If I see that today is the lowest price of the last year, you really don't need much more confirmation of a downtrend than that, or the highest price on the chart of 1 year of trading. Okay, but basically, I'm not forcing my opinion on the market. I'm looking at all the currency pairs, and like I've been saying for 2 days, I like to cherry pick. If I'm comparing 4 of them, it becomes a lot easier to say, well, this one obviously is moving down stronger than this one, and it's the one that's moving down stronger that I'll zone in on. Okay, so it's more of relative strength to the other currency pairs, and it becomes easier that way because then you have a benchmark. You're comparing 2 currency pairs. The Aussie dollar, which was my favorite uptrend for most of 2009, and when this market moved down through this low here, I stopped trading the Aussie dollar, and at the point in time I was on the Euro Aussie, probably the Euro Kiwi, and I can't, boy, it's such a long time ago, beginning of the year. But I quit trading the Aussie dollar as soon as it moved down through this low, even though it's still above the 200-day moving average. But at the time when it makes a new high, which my understanding, people are telling me that it pulled back off the highs, and it may not have done that. But I haven't been trading this pair since probably about in here. But there are other pairs that were moving on to make new highs and to new lows, and I would rather concentrate on those. So if I quit buying, that does not mean I'm looking for selling opportunities. It moves into that gray area. I'm looking for the clearest trends. Okay, that means I'm not trading it anymore. And the Euro, I love this chart because people say, does anybody really follow the 200-day simple moving average? Well, the Kiwi dollar does. We know that. It was just kind of hugging it all the way up. And obviously there were people who were trading this range and just watching it as it moved above and below and above and below, and they just kept trading it at the time. So this indicator, the 200-day simple moving average, is probably the most popular in the world and is also used by some of the biggest traders in the world. Okay, and people ask me why, and I like to tell them that when you're thinking of mutual fund managers, they're looking at hundreds of stocks. They need a way to quickly have a quick reference point on it to say uptrend, downtrend, or whatever. And mostly what they do is use computers now where they can quantify it. And the 200-day simple moving average is really the base of that code that they use to identify strong trending markets. Okay, which means it becomes a self-fulfilling prophecy at the same time. If there's big money trading off of that, then you're going to see this kind of situation here, where there's no reason for this market to go into downtrend. So every time it moves down to the 200-day simple moving average, we're going to look for buying opportunities. And that's basically what it looks like on a chart. But I'm not trading that. And this is my favorite uptrend right now. I think we are well above the 1, or at least we were last time I looked. And we just see the series of higher highs and higher lows. But mostly it's just nice separation between the market and the 200-day simple moving average, and they're both moving up. Okay? And I continue to talk about this because I think this is really the most important step in trading, and it's the first step we should take. Everything else we do can fall into place if we pick the right currency pair to begin with. Okay, I mean it's really key. I'm a big believer in identifying the markets and then trading those particular markets rather than just concentrating on well, I only trade the euro dollar. And a lot of people do that. I want to become an expert on the euro dollar. And that's fine if that's your style. But I'm a believer that limits you. Okay. I mean, that really limits the opportunities because when you go into a situation where the euro dollar really seems directionless, what are you doing? You're probably getting chewed up. You're having a series of poor trades, potentially losing trades. And then you look over to the Euro Aussie and say, wow, I wish I'd be trading the Euro Aussie. Well, it's easy enough. Call up the Euro Aussie, hit the buy or the sell, And so I try to be an expert on the strongest trending markets I can find, okay? And to me, it just makes it easier. It makes it easier to trade that environment because I've already got my directional bias. Now all I have to do is use the approach that I've been developing for half my life to identify my trades in the direction of the trend. Yes, sir. Pardon me? When? I know. Some guy in the last group. Is he here? The gentleman here was calling me out on that in the last? Yeah. Obviously at this point in time, I don't particularly remember, and it was this chart too. That wasn't you though, no. Was that a friend of yours? Did you guys get together before that? At some point back here, it became a new high for the year. Okay? I don't remember exactly what day it was, but at some point back here, we started trading this. We started trading it last summer, the Aussie Swiss. Yeah. Well, if it goes up to a new year high, it better be above the moving average already. Okay? And I don't want to say always, because I'm sure there's going to be a situation where it could make a new year high and still be below the 200-day simple moving average. But I would think that the vast majority of the time it's already going to be above it when it makes a new year high. And to me, a new year high is about as good as it can get for a confirmation of an uptrend, and a new year low is as good as it gets for a confirmation of a downtrend. Okay? And that's why I use about 1 year of trading. And you can see, I think it was sometime in here it made a new high for the year, and it just continued to move up for the rest of the year. But frankly, I probably was not trading it down here. I may not even been trading until it popped above there. I don't remember the exact time, but I do know that it was sometime last summer that we identified this as our favorite uptrending market, because all the other markets were moving down at the time. Except maybe the Aussie dollar and the Kiwi dollar. Yes, sir? Yeah. No, not the calendar year. The last 365 days. Okay. That's why I've got it April 13th, and I think I may have done this about that time. I just put 1 year of trading on my chart, but it's got nothing to do with the calendar year. Yes, sir? The daily chart is by far the best chart to use for any technical analysis, but particularly identifying the trend. Now, yeah. Yeah, well, I used to play around with that. I look at a year, and my initial impression was that if it was above the 200-day simple moving average for about 6 months, that would be good enough for me. But there were situations where it dropped down below it, and only like the EuroCAD, I think it had only been down below the 200-day simple moving average for about a month. But it poked down to a new low at the same time for the year. And that's all I need to see is the actual price being a new high or new low of the previous 365 days. Yes, sir. Well, sure it does. But I think it has more to do with interest rates than the commodities. Okay, the Australian central bank has been the only central bank aggressively raising rates for maybe 8 months, 9 months now. Everybody else is lowering them or giving us reasons why they don't want to raise them. And what we know in FX trading, that higher interest rates usually lead to a higher currency value, while lower interest rates usually lead to a lower currency value. And now recently, Australian central bank came out and said, well, maybe we don't need to raise them anymore. So now you see the market kind of starting to move sideways. Traders were playing the momentum of rising interest rates in the Australian dollar. And we were buying the Aussie dollar, buying the Aussie Swiss, selling the Euro Aussie. I was ready to move to Australia because I was just falling in love with the currency. Now that we've identified a couple of strong trending pairs, we want to look for what is known as the classic as the ABC move. Some call it 1, 2, 3. It doesn't really matter. Okay? This has nothing to do with Elliott wave theory. This has been around since before Mr. Elliott was born. I'm not sure when he was born, probably sometime in the late 19th century. But this is the kind of move we look for that any trend trader, whether you're buying pullbacks down to support in an uptrend or buying breakouts up to new highs or new lows, we're looking for the ABC moves. Okay? And this is basically what it looks like. This would be an uptrend. We can see the trending move, the move against the trend, the trending move, the move against the trend, and the trending move. Okay? If you are looking to buy pullbacks and support in an uptrend, you would be looking to buy as close to point C as possible. Okay? If you think and that's what we talked about in some of the workshops we gave on technical indicators, how we can use those tools to help us time our entry at point C. Okay? If you're using, some of you that we're in on the Fibonacci talks, okay, this is what we're looking for, is perhaps on a 50% move down from this, or maybe 61.8% down, and look for potential support there to buy. But it's always the same thing. In trending markets, you're looking for the ABC moves. Okay? A breakout, we're simply waiting for the market to move back up above point B, and we're buying there. That is all a breakout trade is, okay? Breaking out above the previous high. And on the downside, we can imagine it's exactly the same, except not. It's the opposite, okay? We got the ABC move, okay? Again, you're looking for selling opportunities in a downtrend, so we want to try to get into either as close to point C as possible, which is a rally up to resistance in the downtrend, or the break down to a new low, which is below point B, which would be about right here, and that's all a breakout trader does. They don't mess around with this point C, okay? They don't mess around with it at all. They just wait for the market to break down through the previous low to go ahead and sell. That's what breakout trading is. And here's an example of an ABC move on the Aussie Swiss. Okay, we can see point A, the beginning of the move, point B, the end of the trending move, and then a pullback down to support, which is the counter trend move, and then eventually you can see the market move back up to a new high. Okay, again, if we wanted to buy the pullback, we'd be looking to buy a point C, or if we're just going to do the breakout, we would just buy as the market moved up 1 pip above point B. Okay, and anytime I talk about buying on a chart like this, it's always important to point out that I've got this B up here highlighted. Okay, that means that the prices on here are the bid, or the price that you can sell it at. Okay, if I want the buy price, otherwise if I'm buying a pip above the high, I want to click A here for the ask, which is the buy side price. Okay, you got to remember there's a spread in the markets. And that spread could be 2 pips or could be 4 pips depending on the currency pair I'm trading. Okay? So if I'm buying using a buy stop to get into the trade, I want to make sure that I've got the buy side prices. And if I'm selling, I want to make sure I have the sell side prices. It wasn't until, market scope charts are great charts, but when they did this, I don't know really many other charting packages that offer that. Okay? Because a lot of times we still get calls from people saying, I got stopped out. I had a buy stop in, I got stopped out, but the market never touched my stop. How can you explain that to me? We said, well, we were looking, did you hit point A and see what happened? Oh, and that's usually all the response you'll get. I realize that now. There's sell side prices and buy side prices, and that's what market scope charts will offer you. Okay, so if we're using a buy stop to buy above the high, we want to make sure we click A first so we can see what the buy side high was. And on the Euro Aussie, a strong downtrend below the 200-day moving average, just an ABC move. The breakout would be to sell below point B, or if you wanted to buy the rally or sell the rally up to resistance, you would want to try to use an indicator at point C to help you time your entry. Yes, sir.
What made you not choosing that one as your B and C?
Well, it wouldn't be as fun on the chart if I did that, would it?
When you're in there, you don't know, right?
That low did not go down through that low. Okay, that's really my only determining factor. That's why when you have the ABC move and you're doing the breakout, you have the advantage of waiting for confirmation of the market breaking down through the previous low or up through the previous high. Okay? Sure. Yes, sir.
We're in a short position here.
Yeah.
Why aren't we going long on occasion when it's reversed?
Oh, you can.
Would that kind of be a natural thing to do? You've been in a short side or vice versa?
Yeah. Well, unfortunately, it is a natural thing to do for a lot of people. We call them SSI casualties. Those are the people who are providing liquidity for me as I get into the trade.
You know you're in a short
Yeah.
position. I know that.
Yeah.
But during that time period, you might even get stopped out.
Oh, sure I will be.
And when you get stopped out, wouldn't that be a good time to reverse for a short period of time? Pay attention to it?
Yeah, but I've been stopped out and the market's moved 5 pips higher and reversed and gone back down and made me angry. You know what would really make me angry? If I would have bought at that point at the same time and given up everything that I made in the trade before. I just won't do it. I just won't do it. I just will not buy in a downtrend or sell in an uptrend. It's a sucker's play. It really is. And believe me, I've tried like everybody else has tried. But we offer that information in SSI, and it just proves time and time again that rule number 1 to trading is trading with a strong trending market, and rule number 2 is to repeat rule number 1, So, yes, ma'am. I'm sorry, back here. I've just been talking about that for 2 days. You can use any indicator, whatever one makes the most sense to you. When people ask me that, I prefer slow stochastics. I use 15, 5, and 5 or 14, 3, and 3. But they really all tell you pretty much the same thing. It's just which one seems to talk to you. You know, I've had people say, well, Tom, I don't get stochastics, but I get RSI. What do I do? Use RSI. Don't worry about stochastics. Most moving averages are really just fancy, or most indicators are fancy moving averages. You know, some will get extreme at different points than others, you know, but you really don't need more than 1 or 2 on there to help you identify. You know, we can see that we've got a point C here, you know, and if the indicator you're using is not even getting close to offering a signal, you know, pop another one on there. It really doesn't matter. Or if you don't want to do that, just wait for the breakout. This is what more breakout traders do. They say, the heck with the indicators. I'm just going to wait until confirmation that the downtrend is intact, and confirmation is when it makes a new low. Okay, but you can really use any indicator on that to help you time your entry. Basically, that's all indicators do. They're designed to help you time your entry. They won't tell you anything else. But if we've got an ABC move and we're looking to sell here, all of a sudden that indicator becomes a very valuable tool. Okay, so anyone you prefer. Yes, sir. No, I'm not. No, I'm not. I'm just using that strictly to help me identify the trend. Okay. As I'm identifying the ABC moves, and a lot of people have asked me, you know, if I got in, you know, let's say I got in here below this, you know, and my stop was up here. You know, as the market makes new lows, I'm moving my stop down with the new highs, with the new ABCs that I'm trying to identify. Okay, and I'm going to show you some tools here that make that easier, so you're very consistent in identifying the ABC moves. Yes, sir.
In your last presentation, you gave us the pairs that were your favorite trends.
Yeah.
Pairs, but you gave them so quick that I didn't get them down.
My favorite is the Euro Aussie, and my second favorite is probably the Euro CAD. My third favorite is the Aussie Swiss, and my fourth favorite is the Euro Dollar, which I think is the move I missed while I've been here, because I think it dipped below 130 sometime today, if not mistaken. Yes, sir. Yeah, these are all ABCs. A strong downtrending and uptrending markets are just a series of ABCs, one after another. Yeah, because this is going to be A for the next move, C/A, as we look for the next ABC. Yeah, here? Yeah. Most likely, sure. Absolutely, absolutely. And we're going to go back to, if you were in my last, almost got me. If we were in my last class, we talked about the Donchian channels or price channels to help make it easier to see those. Well, I'm going to pop those up here in a few minutes. All right. How many people use limit orders to get in their trade? You like to get that top pip, okay? You want to know why most professionals don't do that? Okay, I want you to think about this a second. When you use limit orders because you're looking for that very, very top of a move, if you're selling, you're waiting for the market to come up to you, yeah, a lot of times you'll miss that trade. So traders start to think, if I use limit orders to get in the trade, I'm going to be in all the losers, because if it keeps moving up, I'm going to get in, right, eventually? But I could potentially miss some of the winners. But if I use stop orders and just buy the breakouts, I'm going to be in all the winners, but I'm going to miss some of the losers. Everybody following me on that? Yeah, I'll do it again. Let's go back to the ABC. We have a lot of traders that instead of using technical indicators, they try to pick, well, I'm going to sell it at 160. It's going to come up to 160. And they'll sit there and put a limit order in to sell at 160. And they'll sit there and wait and wait and wait and wait, and they may go to bed at night, wake up in the morning, and guess what? They missed it. They missed it completely. They missed the trade. The market did exactly what they thought they were going to do, but they didn't get in because they were trying to nickel and dime the market, getting those last few pips. Okay? So and I read this years ago when I was in Chicago trading, that one of the guys at the Board of Trade, Chicago Board of Trade, wrote that most of your successful traders get in using stops, not limits. And I thought, well, you know, aren't they giving a lot away? Well, most successful traders, automatically that tells you no, they're not giving most of it away. If you're looking for that high level, you're going to miss some winning trades. But if the market continues to move up, you're going to be in all the losing trades, okay? But if you only buy below point B, if the market continues to move up and up, it's never going to move down there. So you're going to miss some of the losing trades. But if the market goes down to 150, it's got to go through point B first. There's just no way around it. So you're going to be in all the winning trades and miss some of the losers if you get in with stops. If you get in limits and try to get that last pip, you're going to miss some of the winning trades, but you're going to be in all the losers. Okay? And just that little change can mean a big difference in your overall results. Okay? So when I read that, I started looking at the markets a little bit differently. Okay? Yeah, it took me a while to figure out what the heck he was talking about at the same time, but if you think about it a while, it starts to make sense. Okay? Which is why I started using the technical indicators at point C and just eliminated the price itself. You know, if I thought the market was going to move up to 160 and I put a limit order to sell there, I would have missed this trade. Okay? But if I'm using a technical indicator to show me when it rolls over, then I'm going to be in the trade if it actually does roll over. Or, better yet, if I'm selling on the breakout down through point B, I'm going to be in all of the trades that move down to the 150 level. Okay? So the point I'm going to get into is why breakout traders, why they trade that way. Yes, sir.
I'm sorry, I don't understand your terminology here.
Okay.
You say getting in using a limit order.
A limit order means I want to get in at a price level or better. If I'm selling, let's say I want to sell at 160 on a limit. That means I'm telling the market that I want that sell price to be at 160 or higher. Okay, that's a limit order. I'm limiting the price that I can get in on. Okay, if I do that, I may have missed this trade because it never hit the 160 level. Okay, good, thank you. See, thank you for bringing that up because I'm sure a couple other people were thinking the same thing. Now, there are other ways to identify breakout trades other than using support and resistance. And let's talk about our first big trader. How much time do I have and how much? I have plenty of time. W.D. Gann. Most people heard of W.D. Gann? If you've ever read W.D. Gann's books, I apologize for W.D. Gann. They're very, very difficult to understand. And you will see people say, selling W.D. Gann analysis, selling W.D. Gann approach to markets, and you start reading it, and it's horoscope and astrology and angles and lines and everything, and it just doesn't seem to make a whole lot of sense. So you'll find a lot more W.D. Gann authors than you probably will W.D. Gann traders, okay? But at the foundation of W.D. Gann's trading was he was simply a breakout trader. We talked about price channels in the previous, but for those of you who weren't in there, W.D. Gann was the first one in writing to put buy above a high of a previous number of days or sell below the low of a previous number of days. And he didn't actually have the charts, so he just used the table, okay? And his numbers were 7. In an uptrend, he bought if the high was above the 7-day high, as the high above the previous 7 days, and he would sell as the market moved down below the low of the previous 7 days. Okay, so how did he identify that? I'm starting here on December 22nd of 2009, and I'm basically putting the high and the low of each day here. Okay? Right on through when I did this on April 16th. This is the high and low of the day. To even adopt it, or adapt it, I should say, to FX markets, I used the buy side high and the sell side low. Okay? Remember, I went to the A and the B on the chart. Okay? If it's in blue, that means it was higher than the highs of the previous 7 days. If it's in red, it was lower than the low of the previous 7 days. It's simply that. If we looked at the high temperature for last week, if we want one higher, that would be a breakout, okay? Because we moved higher than the high of the temperature of the last 7 days. He did the same thing with prices. Okay, is everybody with me on this? So even though in a strong downtrend, you can see you have a number of days where it kept making new lows below the previous 7 days. Okay? And we can see, because we're in a downtrend, that the highs were limited. We had a number of reds, one blue, a number of reds, one blue, and a number of reds. So when did he sell? He sold when this market moved down through the low of the previous 7 days, which is, this was actually the low here, 162.90. So his entry, or actually it's 161.83, 161.80, I'm sorry. I know I had it on here. because I picked this day for a reason. So he basically sold at 161.79. Okay, and he would just ride it every day until it made its new 7-day high, which is probably about the 157, whatever it seems to be right here, 157.93. So he sold at 161.79 and bought it back at 157.83. Okay, just using this simple approach to trading. Remember the key: a strong trending market to begin with. Okay, if the market's moving sideways, you're going to get chewed up using this. Yes, sir. No, that's got nothing to do with it. It's just basically I want to note when today's low price is lower than the previous 7-day lows, or if it's higher than the highs of the previous 7 days.
But it's lower than the previous 7-day lows, wouldn't that mean the 7 days is going down?
Yeah, absolutely. In a downtrend, that's good information. And that's what all these days are.
Well, that's what I mean. In other words, are you saying that after 7 days, typically the run of a low is usually no more than 7 days or 8 days or something like that?
No. It's just a reference point I'm using to, like we talked about the Donchian channels before in the last session, and that was 20-day high and 20-day low. We talked about the turtles using 40-day high and 40-day low. He just happened to be the first one to put it in writing and use 7-day high and 7-day low. And eventually you can see you don't need to see a chart. You can tell this is in a downtrend. Because look at how many days in red you have. And in blue you can start seeing the ABC moves without actually seeing a chart. Okay? This is fantastic for end-of-day traders. For those of you who don't have time to stare at the markets all day, this is absolutely perfect, because all you have to do is check the market at the 2 p.m. local time close, 5 p.m. Eastern. As you put the high and low for the day, you know tomorrow, if you're in a downtrend and you've got this day here, you know you can put in an entry order to sell below the previous 7-day lows. And on this day, it got hit at about 156 something. Okay? So all you have to do is check the market once a day to use this style of trading. It's end-of-day trading, and it really doesn't get much better than this. Is the first guy that really brought it to light. So at the foundation of WD Gann was something as valuable as this. Okay? Yes? What? I'm sorry? Oh, this one? This is our C. Now, as the market's moved down, then it's bounced up. It's bounced up high enough to be above the high of the previous 7 days, so we put it in blue. So now we know to start looking for a selling opportunity, because it's a downtrend, so we want to look for the next point where it moves down 1 pip below the previous low of the 7 days. And that's where we want to enter into the market. Okay? As this market ends here on February 10th, we know what the low is for the previous 7 days. We can put our sell entry order in to sell at that point, and on this, right in here, sometime during the day, it got hit. Well, if that's well, let me see. We've got 1, 2, 3, 4, 5, 6, 7. So it looks like this is the low right here at 155.87. So we put in our sell entry at 155.86, we'll say. And at 155.86, while we were sleeping or at work or something, we got into the market. And if the market closed down there, we were thinking that we were probably brilliant. Sure. Yeah, I would start doing it from that point on. Every day, and that price would change depending on the lows of the previous 7 days. On the next day, I would shift it down and use the previous 7 days. And I would look to sell as it moved down, as a breakout, down through the lows of the previous 7 days. Okay, is everybody with me on this? Because we're going to be kind of be expanding on this. Yes, sir.
I think what maybe he's trying to say is you're saying it doesn't really matter over a 7-day period, it could be any time. If it runs the lowest, you use that as your base over 7 days. It doesn't matter if it was 6 or 6 days, just over that period. It was the lowest,
Yeah.
the highest is what he's saying.
Yeah, I'm just counting back 7 days and looking at the lowest low price of those 7 days. Okay? Yeah. Yes, sir. Uh-huh. No, because what I'm looking for about 1,000 red days in a row and no blues. Okay? I'm getting out. If I got in here on this day, then I also know where my stop is, because my protective stop is going to be 1 pip above the high of the previous 7 days. Exactly. Exactly. I know. Yeah, yeah. We got the bad deal on that one. Yeah, but I know exactly where my stop is going to be. It's going to be 1 pip above the highs of the previous 7 days, and it's going to sit there for 24 hours. And at the close of the next session, I'm going to use the day that just closed plus the previous 6 and look at the high and move my stop down to that level. At the close of the next day, I'll use that day in the previous 6, look at the highest high, and move my stop down to that level. And hopefully continue to do that for the rest of my life. I'm just making money. But obviously that didn't happen. On February 25th, sometime during the day, we got stopped out of this trade because it moved above the high of the previous 7 days, which is about 153. Does that look like 153.16? So 155.86, 153.16, you know, a nice trade of 200 and some odd pips. Yes, sir. Yeah, we're going to get into that right now. Absolutely. And there is a relationship, too. Yes, sir. I'm sorry? I do, always. Yeah, always. Unless there's like a G7 or G20 meeting going on, then I really kind of shy away from that. But other than that, there's nothing going on. In spite of what's been happening the last few weeks, I just continue to let it ride over the weekend. Okay, and we have on the flip side the Aussie Swiss. You can see by the number of blue candles that we're in an uptrend. Okay, but we're doing exactly the same thing on this. Okay, we just have to change our entry or our stop once a day, and that's at the close. I mean, you don't have to be there right at the close. If it's a couple hours later, it really shouldn't make that much of a difference. Okay? A question or just yawning? Okay. Thanks for the confirmation. All right. So 1960, some guy got a hold of this and tried to do something. But what do you think the main difference between 1960 and 1910 would be? Yeah, volatility because of the technology. More people trading. You know, people started getting in the nifty 50s. Merrill Lynch they were getting in their vans and going around to cities and selling investments. Okay, everybody was starting to get in the market, so volatility started expanding. So those 7-day highs and 7-day lows really weren't working anymore. So a guy named Richard Donchian, I'm getting ahead of myself. Here we go. Born in Hartford, Connecticut in 1905. Probably read the W.D. Gann book and said, you know, I don't understand all this other stuff, but I like this 7-day high, 7-day low, and started playing with it and didn't work. So what would you do? Yeah, let's make it 20 and see what happens. Why 20? 20 trading days in a month. Okay? Basically, he's looking for the month high or the month low. But it's 20-day high, 20-day low. It actually made him famous. But obviously there was a lot more, you know, he was doing a lot more than that. But the Donchian channels today are basically 20-day high and 20-day low. And that's what he used for the longest time to become a very successful trader. It was just the same thing. It was just upgraded to move along with the volatility of the market. Okay, now if we go to MarketScope charts, we can put the Donchian channels on there. I'm going to give you a website. It's www.fxcodebase.com. That's fxcodebase.com. If you go on there, there are dozens of technical indicators with a code that you can add very easily onto the MarketScope charts. And Donchian channels are one of them. Okay? And this is what it looks like on the Euro Aussie with the 20-day high and the 20-day low. Whether you're choosing to buy the breakout down through the lower band and just ride the trend, and this is your trailing stop moves with the upper band, or what some traders do, like myself, when it touches the upper band, we may move down to the 4-hour chart to identify our entry in the direction of the trend. It doesn't matter. But the breakout traders, all they were doing is buying when it touched the bottom band, or the channel, excuse me, when the market's in a strong downtrend. Okay? And they just followed up the protective stop with the new 20-day high, and here's where they were stopped out. They got in here, they were stopped out here. They got in here, and they're still in. Okay? And many, many traders did that for the longest time. And on the upside, the same thing. Let me go through this because I want to talk about the last group. All right, now as the 70s came around, institutions started getting computers. You know, they may have been cards and everything, but it was computers, and they can really pick up the speed and they could analyze these kind of things, okay? Now, particularly using code and identifying these kind of situations. But that also brought in more short-term traders. Now you started seeing people using intraday charts, okay? It was very hard to get intraday charts mailed to you, obviously. I mean, what good is it, David, a 1-minute chart mailed to you by the time you got it, you know? But if you've got the computer, you can see it live. Now all of a sudden, guys say, wow, I think I'm going to start trading on 5-minute charts. So what is that? What do you think that meant? More volatility. Absolutely. Okay? And that brings us to our next group of traders, which may be some of the most famous traders of all time. In mid-1983, Richard Dennis was having an ongoing dispute. I want to read this one because this is actually good. Okay? An ongoing dispute with his longtime friend Bill Eckhart about whether great traders were born or made. Dennis believed that he could teach people to become great traders. Eckhart thought genetics were the determining factor. An arrogant son of a gun, I think. In order to settle the matter, Dennis suggested that they recruit and train some traders and give them actual accounts to see which one of them was correct. They took out a large ad advertising positions for trading apprentices in Barron's, the Wall Street Journal, and the New York Times. The ad stated that after a brief training session, the trainees would be supplied with an account to trade. What he didn't mention, that account was $1 million, and it would be 30 days after he taught them how to trade. Okay? So they just took people from all walks of life. They made sure that it wasn't just people who were experienced traders. They really didn't want experienced traders because they didn't want to, you know, deprogram and then reprogram. You know, they just wanted people that maybe been mathematically inclined, you know, people, but it was a variety of background. Artists, they had musicians, champion chess player. I mean, they had all kinds. They had a couple of gamblers from Las Vegas who answered the ad and did it. Sorry? The group was invited to Chicago and trained for 2 weeks. See, I lied, 2 weeks, but actually it was a month. At the end of December 1983, they began trading small accounts at the beginning of January. And after they proved themselves, Dennis funded most of the trainees with $1 million in February, so it was about a month. And these students were called the Turtles. So if you ever heard of Turtle Traders, this is the story. The Turtles became the most famous experiment in trading history because over the next 4 years, they earned an aggregate sum of over $100 million, okay? Not too shabby. In fact, Richard's dad liked to tell the story that Richard did a pretty good job in trading. He started with $300 and ran it up to over $300 million, okay? Not too shabby. But he thought he could teach people to do that it wasn't that hard, it was simple, you know? And actually, these guys were friends from childhood. So this wasn't, you know, they weren't being mean-spirited to each other. Because if you think Dennis, Eckhart, D&E, they actually sat in homeroom together because in Chicago they would sit you in alphabetical order when you got in homeroom. And so they actually sat like one behind each other for most of their life growing up, and they became friends, went into trading together, and it culminated in this experiment. Okay? And obviously he proved that it was correct. Now what I've got up here, they obviously saw more volatility. So they said instead of 20, they obviously knew Richard Donsheen and heard of him, they upped it to 40. Okay? They used 40-day highs and 40-day lows. And we can see on this chart there was only one trade here, but you would have bought about 171 and you'd still be holding on to this boy. Okay? Not a bad situation to be in. But one thing to keep in mind, the key to their style of trading was they were trading the futures markets and they traded all the markets. Okay? Because typically their winning percentage was somewhere about 35%. Okay? And there would be 2 or 3 winning trades a year that would be the bulk of their returns. Okay? Meaning from $1 million to hundreds of millions of dollars over the next. And as a matter of fact, if you look today at some of the top money managers, hedge fund managers in the world, out of the top 10, I checked a couple of years ago, I checked from the results from a couple of years ago, and 5 of them were still turtle traders. Okay, so they are still around today, trading and making incredible amounts of money. Now, they've obviously tweaked this approach a little bit, but at the foundation of their approach is still selling new lows and buying new highs. Okay, and this is the 40-day. This is just a 40-day Donchian channel to where they'd sell here. This is their stop, and they just move their stop down with the channel until the market comes up to stop them out. Okay? And the key was that they traded all markets because they never really knew which market was going to become the strong trending market. Okay? I like to quantify that in the beginning and pick the strong trending market and then apply the channels and use it in that fashion. Okay, there's nothing wrong with that. Okay, but I'm just trading for myself. I'm not managing, $100 million where you just can't put it all in the Euro Aussie. You just can't get on the phone and, sell me 100 million Euro Aussie. That doesn't work in today's markets. So they obviously were risking about 1% on their trades, okay? But they were also looking at a variety of markets to really diversify that portfolio at the same time. Just breakout traders, just plain old breakout traders. And on the Aussie Swiss, we saw it was a little bit more, it was jumping a little bit more, but we've got the same thing, that if you're buying at the 40-day high, this is your trailing stop, and as you can see, you're still in the trade. And I would be willing to bet there's a couple of turtle traders out there that are still hanging on to this trade too. Any questions on that, what we talked about? I think I'm going to get into what I recommend right here, if you'll give me 1 second. Yeah, let me answer that question because I got some charts to show how I might be able to adapt that to today's FX markets, okay? They also use the 55-day breakout. Fibonacci number, okay, you can see that this got in here, and obviously they're still in this trade today, okay? But as I look out there, I know that people are going to say, well, I don't want to trade in March of 2009 and hold it for a year. I mean, it sounds like fun, to have this winning trade. But obviously, I think a lot of people would rather be a little bit more active in their entries and exits. I would be anyway. So here's one way to look at it. Remember I talk about quite often that I use the daily chart to identify the strong trending markets. That gives me my directional bias. And as I identify that strong trending market, I don't mind moving down to the 4-hour chart to identify my entries and exits in the direction of the trend. Okay, and this would be one way to do that. Use the 20-day Donchian channels on the daily chart to identify the highs in a downtrend or lows in an uptrend. Okay, so I'm not looking for the breakout. If it's in a downtrend, I'm looking for when the market moves up and touches the high. And then I can go down to the 4-hour chart, and I think you have to kind of use a bigger number on the intraday chart because obviously there's more volatility. And to use the 55-period Donchian channel on the 4-hour chart to identify my entry and exit in the direction of the trend. So first this has to happen, and then I move down to the 4-hour, and I look at that to identify my entry and exit. This is a daily chart. Okay, I'll go back a second. You need the little iPhone, and just take a picture of it so you don't have to. Yes, it will be. Yeah, these PowerPoint presentations will be available. Okay, let me move back here because I want to cover this. We got about 7 minutes. So on February 2nd, I'm using the 20-day Donchian channels on the Euro Aussie. Okay, instead of buying on the breakout down to the low, once the market moves up here, I know that that's a move up to point C. Okay, I can see A, B, C. We've got the A, B, C. Okay. This is where I want to look for selling opportunities as the market tests the upper channels. So this is the first step I look for. Okay, strong downtrend, Donchian channels, 20 period. The market's touched the high. That kicks off a potential selling opportunity. Okay, so at this point in time, I will move down to my 4-hour chart and use a 55-period Donchian channels to identify that entry in the direction of the trend. Okay, so this is where it is on the 4-hour chart, and as you can see, you'd still be in this trade today. Okay, this is from the February 2nd high. And this is where my stop would be. This is on my trailing stop. I had a lot of people ask me, how do you use Donchian channels, or how do you move your stop with the market? This is one great way to do it. Okay, so right now my stop is going to be above up here, and I think this market has actually moved down. I think we're at about 144 today, if I'm not mistaken on that. Yes, sir? Right here. Yeah, because I knew where the band was, but I can't check every day. I have to really kind of keep an eye every 4 hours. Because every 4 hours there's going to be a new candle. But it is a 55-period Donchian channel, so I can tell beforehand, it's not going to move all that much as quickly as a 20-day Donchian channel would. Okay, so I kind of know, before I go to bed at night, I'm going to know whether that Donchian channel is going to move or not, because I can just count back, to 55 and kind of tell if the low is going to change dramatically at all. Okay, so it's only 6 times a day. Yes, ma'am. No. Well, like for here, this might be a week. So I may not move it for a whole week. Okay, but as soon as I see this channel move down here, then I move my stop down, or 1 pip above the buy side high, the A for ask. Yeah, I can't help myself on that. I check way more often than I need to, And I'll bet everybody else here does too. Sometimes you just can't help yourself. I'm sorry? Yeah, well, manually trailing, I do it myself. No, I would never do an automatic trailing stop. The one time I do that when I tell people to use the 1 to 2 risk-reward ratio, if you don't want to use a money management approach like this, otherwise if you're risking 100 pips on the trade, you're looking for 200 pips in profit. If the market moves halfway to your target, I don't mind moving the stop up to break even, but I only do it once. If you really are active in moving your trailing stop, you're going to get stopped out prematurely. Okay? But using a 55 period on the 4-hour obviously shows that that's plenty of room. It's giving the market plenty of room to breathe, because we can see all these ABC moves down here. They never moved up enough to stop us out. Okay? So I'm giving the market room to breathe, but at the same time, as soon as here, you can see that the market was already at break even, at this point, because my stop was here and my entry was up here. So at this point in time, I can look at the other currency pairs and find another trade, because I basically have no risk in the market. Theoretically, no risk. Okay? Yes, sir. Yes. Sure. That's what it looked like on the daily chart, right here. Yeah. This is at this point, as soon as it touches that upper channel, I'll move down to the 4-hour chart, because I'm looking for the rollover back to the downside. And by waiting for it in the bottom channel on the 4-hour, otherwise I'm looking for the test of the top of the channel to initiate the potential selling opportunity, and then I move down to the 4-hour. But I do want to wait for it to touch the bottom channel as some sort of confirmation that the sellers are back in charge. Yeah, and it really hasn't been working. It really hasn't worked for me. I'll continue to play around with that. Of course I do, and that's one of the things I like doing anyway. But the only reason that I think this may work on the 4-hour chart is because I'm using the daily chart to initiate, to identify the selling opportunity. Yes, sir. When the market moves back to touch me out here, because my stop is continually being moved down to 1 pip above this level. So when the market reverses and moves up through the upper channel, that's when I'm out. Yes, ma'am. I'm sorry? Right up here at the top of the channel. So this is my risk between the entry and the top channel there. Yes, sir. Yeah, I only risk 5% of my account balance at any one time. That does not mean on one trade, and I open up 5 trades risking 5% on each. I risk it at one time. So as soon as I'm in this trade, I'm committed to this one trade. But as soon as this market moves down to this point where my stop is at break even, I can take that 5% and look for another trading opportunity. Okay, if times are going well in strong trending markets, you can be in 3 or 4 open trades at a time. Okay, yes, sir. Well, that's what the turtles use, so I just threw it on there and see what happened, and it looked good. So obviously I'm thinking that there was a reason they did that. Like I said, I have no need to reinvent the wheel. It was strictly because they used it, and I'm sure they used it just because it was a Fibonacci number and it was a big number. So it makes for a good story anyway. But in this situation, obviously, it's just about where I want it to be. So when I saw that, I thought, well, this is why they're using that. Yes, sir. Are you going to do that next week? No, you got. Yeah, I think you have to be careful on optimizing, and because you're basing your rules on today on just the last trade. There's a reason that a lot of these are default settings. It's because they were developed that way and they were optimized to begin with. And they've worked over time. So which is why people really don't kind of get away too much from the default settings. Unless you have reason to prove that you found a better setting. I used the 20 because Richard Donchian used the 20. I used the 55 because the Turtles used the 55. And I'm thinking there's reasons why they did that is because they turned a million into tens of millions. That's a pretty good reason for me. Thank you very much for joining me. Really, thanks very much for coming this weekend. I've got to head out of here because we're going to the airport, but I do appreciate you coming here and spending a couple of days with us. Thank you very much.